Welcome to the Deep Dive, where we take a stack of your sources and pull out the most important nuggets of knowledge and insight, custom tailored for you. Today, we're diving into something that honestly feels incredibly relevant in our noisy world. Financial freedom starts with saying no.
Hmm, that's a powerful idea. Saying no.
Yeah, exactly. We're going to unpack this maybe counterintuitive idea that building real long-term wealth, it isn't really about finding the next big thing or, constantly chasing the latest trends. It's more about the discipline, the real grit of saying no.
Saying no to what specifically?
Well, no to speculation, no to all that financial noise swirling around, and definitely no to those flashy, often expensive fads.
Got it. So resisting temptation, basically.
Precisely. And to guide us, we're pulling insights from two absolute titans of investing. We've got John C. Bogle's Common Sense on Mutual Funds
A classic.
and Benjamin Graham's foundational work, The Intelligent Investor, plus bits from Security Analysis.
Right, the bedrock stuff. So our mission today really is to distill the core wisdom from these masters. We want to show you how resisting those common temptations can actually be your shortcut to becoming truly well-informed and financially resilient. We'll look at not just what to do, but maybe more importantly, what to avoid.
Okay, let's jump in. It feels like every single day, doesn't it? There's a new must-have investment popping up.
Oh yeah, or a hot stock tip.
Exactly. Or some guru promising instant riches. It's just so easy to get pulled into that excitement to say yes to whatever's trending right now. But our sources here suggest that's often the first step to a pretty dimly lit and usually expensive path.
That's exactly right. Graham makes it crystal clear. A stock isn't just a ticker symbol flashing on a screen.
It's not just an electronic blip.
No, it's an ownership interest in an actual business, a real company. He famously described the market itself as like a pendulum, forever swinging between unsustainable optimism and unjustified pessimism.
That's a great image. Optimism and pessimism.
Right. So the intelligent investor, then, isn't trying to guess the swings. They're a realist who understands how to, as Graham put it, sell to optimists and buy from pessimists.
Okay, but that clashes completely with what you hear all the time, right? The constant chatter about timing the market.
It does, and Graham specifically warns against trying to forecast those price movements. He flat out says the average investor cannot deal successfully with price movements by endeavoring to forecast them.
Cannot.
Yeah. He even suggests forecasts from the so-called experts are, get this, less reliable than the flip of a coin.
Less reliable than flipping a coin, so basically useless.
Pretty much. The key takeaway isn't just that the market swings, it's that your detachment from those swings. That's your biggest asset. It lets you be rational when everyone else is panicking or getting greedy. He points to history, like the New Era investment theory back in the late 1920s bull market.
What was that? Sounds familiar.
It became almost identical with speculation. It stressed future potential over past facts, and crucially, it pushed this idea that a stock's desirability was entirely independent of its price.
Regardless of price. That sounds dangerous.
It was a radical fallacy, as Graham called it, and it led straight to exaggeration and inevitably collapse. So saying no to forecasting, no to that new era hype, that's step one.
Okay, mental shield up against predicting the future. Got it.
Yeah.
But even if we resist that, what about just the sheer volume of noise, the daily headlines, the hot takes?
Oh, the noise. That's another huge distraction. It's not just background static. Often it feels like it's designed to pull you away from what actually works.
Designed.
You think so?
Well, Bogle points out the blathering blandishments of the brokerage community and the enervating cacophony of television's talking heads. He doesn't mince words.
Blathering blandishments.
Wow. He even says, almost playfully, ignore Jim Cramer. Pay attention to Jack Bogle. Huh? Okay, that's pretty direct. It really highlights how maybe the industry's incentives aren't always aligned with ours, the average investors.
Exactly. All that high-pressure talk, the constant TV chatter, it often just serves to confuse, to make you feel like you have to do something. Graham gives an example, the January effect. Remember that small stock supposedly popping in January.
Vaguely, yeah.
He points out, look, if an opportunity is this easy, surely everyone would know, everyone would do it, and poof, the opportunity vanishes.
Right, he gets arbitraged away.
Exactly. It's chasing a trend that's already over. And this connects to another key point. Investors themselves have adopted these consistently counterproductive investment patterns. Think about this. Back in the 60s and 70s, mutual fund turnover was maybe 8% a year. That suggests people held funds for, over 12 years?
Okay, that's long term.
Turnover's around 31%. That implies holding for just over 3 years, much shorter.
Wow. So we're getting more impatient. But is that us, or are we just mirroring what the fund managers are doing, like a feedback loop?
That's a great point. And yes, often this short-term thinking is learned right from the managers. Average portfolio turnover for equity funds, it jumped from like 17% in the mid-60s
Okay.
to an astonishing 85% by 1997.
85%.
Yeah, meaning managers were holding stocks, on average, for just slightly over 1 year.
That's trading, not investing.
Precisely. Bogle calls it shuffling through their portfolios like short-term speculators. And for you, the investor, that means enormous portfolio transaction costs,
The hidden fee.
hidden fees, and staggering tax costs, too. His son actually studied this, confirming these hidden trading costs can be really substantial. They can easily shave off, 1% or even more from your annual performance. It's like an invisible tax.
So it really does seem like the industry benefits from all this activity, this churn, even if it hurts the investor. Keep them guessing, keep them trading.
Absolutely. Which brings us to what Bogle calls the tyranny of compounding. We love compounding for returns, right?
I shake of compounding, yeah.
But it's tyrannical for costs. Bogle hammers this home. Cost matters, period. He shows how tiny differences in expense ratios, say 0.2% for a low-cost fund versus maybe 2.2% for a high-cost one.
Which doesn't sound like that much day to day.
Right, but over time, it leads to massive differences in your final returns. In one of his examples, the low-cost fund returned 8.6% annually, the high-cost one only 7.3%.
Okay, 1.3% difference per year. That adds up.
It compounds into a huge drag. Graham calculated that if you combine typical operating expenses, maybe 1.5%, with those trading costs, maybe 2%.
We get.
A total fiscal drag of 3.5% per year. Think of it like an anchor. Your fund has to beat the market by 3.5 percentage points before costs, just to match the market after costs.
That's a huge hurdle, almost impossible for most funds, surely.
It is. Bogle gives this stunning example. $10,000 invested from 1982 to 1999. In an index fund, it grows to over $153,000.
Well, nice.
In a typical actively managed fund, only about $113,700. That's nearly $40,000 less, just vanished into costs and churn.
$40,000.
Yeah,
Gone.
gone. And over 40 years. He estimates the combined hit from expenses and taxes could mean you end up with only 23% of the projected capital.
Wait, you only keep 23%. Less than a quarter of what you could have had.
That's the potential impact of costs and taxes, according to his example. It's staggering.
That is outrageous. It makes you rethink everything. But, okay, what about the other big belief? The star fund manager, the fund with the amazing track record? Surely that's worth paying for.
Ah, the allure of past performance. It's powerful, isn't it? But Bogle is adamant. There is no evidence, none, that superior past performance is predictive of future success.
None, really. We instinctively want to believe that, don't we?
We absolutely do. It's human nature to extrapolate, but the data just doesn't support it. He talks about the powerful pattern of reversion to the mean. Things tend to average out. He uses Legg Mason Value Trust as a prime example. 15 amazing years, then dramatic underperformance.
Ouch. So chasing winners doesn't work either.
Not reliably. Even Morningstar's famous star ratings. Bogle says they have little predictive value, and actually following them, trading based on stars changing, can lead to below-market returns at above-market risk.
So buying high, selling low, basically.
Often, yes. So saying no here means actively resisting that urge to chase yesterday's winners.
Okay. So if we're saying no to speculation, no to the noise, no to high costs, no to chasing past performance, what are we saying a big, loud yes to? What's the positive action here?
We're saying yes to the fundamentals. The simple, powerful principles: time, simplicity, and focusing on long-term ownership.
Time, simplicity, ownership. Bogle is almost pleading here, invest you must. He says, the biggest risk is the long-term risk of not putting your money to work at a generous return.
The risk of doing nothing. Inflation risk. Exactly his advice. Give yourself all the time you can, begin to invest in your 20s, even if it's only a small amount, and never stop. Time lets that miracle of compound interest work. He notes how stocks, over time, build their reward over savings year after year, creating this awesome differential. That's where real wealth comes from.
So time is key. But that requires patience, which feels like it's in really short supply today, instant gratification world.
It absolutely requires patience, and Bogle's ultimate advice addresses that. Follow a simple plan and let the cycles of the market take their course. Don't react to every dip and surge. He says, the secret of investing is, finally, that there is no secret.
No secret. I like the sound of that.
It means eliminating emotion. Impulse is your enemy. Graham echoes this perfectly. He says the investor should expect their prices to fluctuate
Expect it. Don't fear it.
and should neither be concerned by sizable declines nor become excited by sizable advances. Those market quotes. They're just there for your convenience, either to be taken advantage of or to be ignored.
Ignore the daily quotes. That takes discipline.
It does. Graham even offers a simple motto. Never buy a stock immediately after a substantial rise, or sell one immediately after a substantial drop. Common sense, right? But hard to do. Investing should be about protection. Protecting yourself from overpaying, from overconfidence, not about projection of where prices might go next.
Protection, not projection. Okay. It really sounds like both Bogle and Graham are saying, stop overthinking it. Stop making it complicated. Is it really that straightforward?
In principle, yes. Simple, but not necessarily easy, especially when fear or greed kicks in. But they absolutely point towards a remarkably consistent strategy, one that cuts through the noise. And it leads, almost inevitably, to one conclusion for most people: low-cost indexing.
Ah, the index fund.
Graham states it outright. The ideal choice for most investors is a total stock market index fund, a low-cost way to hold every stock worth owning. Just buy the haystack.
By the whole market, why is that so effective, according to them?
Because it guarantees you get pretty much the market's return, minus incredibly low costs. It takes manager risk, timing errors, and high fees almost completely off the table. Bogle showed that an all-market index fund costing just 0.2% would capture nearly 99% of the total market return. And crucially, with substantially lower risks than trying to pick winning active funds.
Lower risk and almost identical returns to the market itself.
Exactly. And it's not just Bogle and Graham saying this. Think about Peter Lynch, the legendary active manager. He said most investors would be better off in an index fund.
Even Peter Lynch. Wow.
Even Charles Schwab. Only about 1 out of every 4 equity funds outperforms the stock market. That's why I'm a firm believer in the power of indexing. Even people within the active fund industry, like John Fossil, admitted the average fund can never outperform the market in total. Bogle calls this the triumph of experience over hope.
The triumph of experience over hope. I like that. It summarizes this whole saying no idea perfectly, doesn't it? Saying no to the hope of beating the market and yes to the experience of mashing it cheaply.
Precisely. And this philosophy, this saying no to complexity and high costs, it isn't just for stocks, right? It applies across the board.
You mean like bonds and international stuff?
Absolutely. The core principles, low cost, diversification, long-term discipline, they work everywhere. For your overall asset allocation, yeah, maybe reducing stocks and adding bonds as you age is a wise starting point.
Yeah.
Basic risk management. For bond funds, low costs are just as critical, maybe even more so because expected returns are lower. For global investing, international index funds offer a sensible approach. Keep it simple, keep it cheap.
It all comes back to simplicity and cost.
It really does, and maybe this sums it up best. Bogle's personal philosophy for Vanguard, it wasn't about complex products, it was to serve the human beings who are our clients. To serve them with candor, with integrity, and with fair dealing. To be the stewards of the assets they have entrusted to us. To treat them as we would like the stewards of our own assets to treat us.
Stewardship, not salesmanship.
Exactly. He said the mission isn't complicated, but anyone who preaches it had better live it every single day. It's about trust and acting in the client's best interest, which often means encouraging them to say no to unnecessary activity and cost.
So wrapping this up then, financial freedom, it seems, isn't really found in some secret formula or chasing the latest hot trend.
No magic bullet.
It's found in that powerful, disciplined act of just saying no. Saying no to chasing elusive extra returns, no to those wealth-eroding costs, and no to all the distracting noise.
It's really about recognizing the market for what it is, a powerful tool for building wealth over the long haul, not some casino game you play day to day. By embracing simplicity, focusing on being a long-term owner, and ruthlessly minimizing costs, you align your strategy with principles that have stood the test of time, principles that actually put your interests first.
Okay, so as we finish this deep dive, here's something to think about. We talked about Graham's market pendulum, swinging between optimism and pessimism. How can saying no to reacting to those swings. Saying no to those short-term emotional responses actually be the thing that allows you to say yes to your biggest, most important long-term financial goals, especially when that pendulum takes its next big scary swing.
And maybe even more provocatively, just consider how often the loudest voices, the ones getting the most airtime in the financial media, are actively encouraging you to do the exact opposite of what these timeless, common sense principles suggest. Ask yourself, who really benefits from all that complexity, all that noise, all that activity? Is it you?